Welcome to the Phuble podcast, where we talk about all financial markets around the world. I'm Philemon Viennas, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. This week, we are in Munich, so we will be discussing just a quick overview of the German economy, the German stock market, and the German government bond market. There are four major equity indices to look at here in Germany, and those consist of the DAX, the MDAX, the Tech DAX, and the SDAX. The DAX measures the largest 30 companies in terms of exchange turnover and market capitalization. The MDAX follows right after the DAX, and that measures the largest 50 mid-cap companies from traditional sectors such as pharmaceutical and financial sectors. And that also is measured in terms of exchange turnover and also market cap. The Tech DAX measures the 30 largest companies in the technology sector, and that also follows right after the DAX in terms of exchange turnover and market capitalization. Then the last index that I prefer to look at here in Germany is the SDAX, and that measures small caps. That ranks right below the MDAX, and that comprises of the 50 next largest companies in terms of market cap and exchange turnover once again. So the indices follow the DAX, then right under the DAX are the Tech DAX and the MDAX, and then follows the SDAX, which of course are those small market cap companies. So closing out the previous week in the financial markets here in Germany, the DAX finished at 12,380 euro, the MDAX finished at 25,833 euro, the Tech DAX finished at 2,822 euro, and the SDAX finished at 10,958 euro. All these indices have been relatively stagnant, but have still maintained a positive uptrend since the beginning of the year. Now, switching over to the bond market, the German government bonds, which are called the Bunds. The 2-year yield is at negative 0.78%. The 5-year yield is also at negative 0.78%. The 10-year is at negative 0.58%, and the 30-year is at negative 0.09%. There is no inversion that is happening yet in the Bund market here in Germany, but an inversion is very close between the 2s and the 5s. All government bond yields are negative right now. So why would anybody invest in negative yields? Of course, when there are negative yields, you will not gain the same amount of money that you put into the bonds when you originally bought them upon maturity. If you wait until maturity with these bonds, you will actually be losing money. So once again, why would anybody invest in them? Well, people are anticipating that the price of these bonds will actually keep going up, which means yields will keep dropping. Why would yields keep dropping? Well, there would be uncertainty within the German economy. So let's go over some German economic numbers. German unemployment for August of 2019 was at 3.1%. It has been declining over the past few years. That is a fantastic number. Consumer spending bounced from 426.09 billion euros in quarter 2 of 2019, and that was up 400 million euros from quarter 1 of 2019. The consumer confidence index increased to 9.90 heading into October 2019. That was up from 9.70 heading into September of 2019. That number signals a positive outlook on the economy by consumers, which is very healthy for the growth of any economy. All the numbers that I just mentioned highlight positives in the German economy, which explains the increase in the DAX indices. So why would bond yields be declining? Well, manufacturing PMI, which gauges sentiment across the manufacturing sectors, dropped to 41.4 in September 2019, down from 43.5 in August. GDP growth in quarter 2 declined negative 0.1%. GDP growth in quarter 1 was 0.4%. GDP growth is still up 0.4% year over year here in Germany, but there is still that drastic decline from Q1 to Q2 in GDP growth. Also, you have to remember that all the economies within the European Union are very, very interconnected. That means that if one economy declines, it will most likely drag down all the other economies. Germany basically supports a lot of the economies here in Europe. They are the leader in GDP. The United Kingdom is number 2 in GDP. within the European Union. Germany is going to have to pick up whatever the UK leaves out. That is going to strain the German economy greatly. Within the European Union, if all the economies are doing well, the leader will most likely outperform all the other economies. If all the other economies are not doing well, the leader will be dragged down by those economies. You have to take the good with the good and the bad with the bad here in the EU. That is all for the Phuble podcast here in Munich. Thank you for watching and happy investing.